The stock market hit major turbulence this week, nursing some steep losses and sharp rebounds following a rocky start to the new year. It is a far cry from the steady gains that we saw through most of 2021.
So when the Federal Reserve's policymakers met today, investors were counting on the central bank to explain how it's going to address rising inflation. To get insight into what came out of the meeting and how that'll affect the stock market, let's bring in Bloomberg's Bailey Lipshultz. Bailey, thanks so much for joining us. I want to start on the anticipation heading into today's Fed meeting. Did central banker Jay Powell provide enough clarity for investors moving forward?
Yes and no. They came out saying that investors should expect a rate hike soon. You should read that as March. But the main question from investors was, how rapid will these rate hikes take place? And from Fed Chair Powell, they basically left the door open for multiple rate hikes at every meeting, a rate hike at every meeting. And that caused some concern for investors because they had gotten so accustomed to Jay Powell and the Fed using some typical language that assured the market of a gradual approach. Everything was going to take place at a very calculated pace. And some of the commentary in the question and answer today with Fed Chair Powell was that investors really should buckle up for the potential of a rate hike consecutively at meeting after meeting.
Okay, so he signaled that we could get steady rate increases, but there was also a lot of uncertainty about what that might look like going forward because we don't know how inflation will shake out. Explain to me why higher interest rates would prompt stocks to fall, though.
Well, when you look at investing, so typically interest rates, when they're higher, make stock markets less attractive. And that's really what we've been seeing when you look back to November, when Fed initially kind of signaled that investors should get ready for additional interest rate hikes in 2022 and 2023. That's why we saw a lot of the high growth tech stocks really fall under pressure. Those are companies that are preferred by the likes of Cathie Wood. Read that as a company like a Robinhood or non-profitable tech companies, because when you're investing, when interest rates are higher, those profits that are coming in 2024, 2025, and 2026 look less attractive in the near term. And that really has been the main messaging from investors that I've been talking to.
And inflation is only going up. The latest read shows consumer prices rising 7%. It seems like a lot of people have been caught by surprise at how persistent it is. When prices first started rising, there was this fun debate over whether it's temporary, transitory. Now it seems pretty clear that it's here to stay. But what is the investor confidence that raising interest rates is going to cool inflation moving forward?
It's really mixed because there are still concerns around supply chains. Supply chains were initially a big factor that drove inflation and drove products that individual consumers were buying higher. And now we're seeing not only sellers raising prices, but they're kind of passing along those costs to consumers. And that's one of the things that investors are unsure of. When you look at it from a generalist investing standpoint, rate hikes should help ease some of the inflation. But we're still kind of in uncharted territory, just given the unprecedented nature of a pandemic like we saw with COVID-19 as we continue to come out of it and as employment really runs near what Fed Chair Jay Powell said is likely maximum employment.
Yeah, the reasons behind the inflation are different this time because we're in a pandemic and we haven't seen this kind of situation play out before in a long time. Bailey, there are obviously a lot of cross currents when it comes to the stock market. Interest rates and what the Federal Reserve says and does is just one part of the picture. You've also got companies reporting financial earnings, and you mentioned a couple of them earlier. We're getting a lot of earnings coming in. This week has been super busy for all the companies that are reporting their financial results. It's kind of like giving their report card to investors. Can you distill an overarching message from the companies that have reported, banks like JP Morgan or tech companies like Microsoft? What is the message from them?
The big takeaway from banks is that they're spending a lot of money to retain talent, and they're keeping a close eye on what consumers are doing, whether that's taking on debt to go out and buy a new car or maybe make a huge purchase like buying a house. That really was the main message coming from banks. But when you look at a company like Microsoft yesterday, really shot the lights out with stellar earnings growth, a stellar outlook for 2022. It came at the right time for a lot of these tech companies that are invested by pretty much everyone in the U.S., whether you're looking at a Microsoft or a Facebook, a Google. Those companies are continuing to deliver, and it'll be particularly interesting this week as we get results from an Apple, looking at what the outlook looks like as these companies kind of go through any supply chain issues and make real broad statements on where they see consumers in 2022. But obviously the market is just about 10% off record highs hit earlier in the year. So there is still a little bit of trepidation about what growth will look like and how active U.S. consumers will be in spending.
Well, also the stock market as a whole has had a lot of blockbuster years from 2019 to 2020 to 2021. What are the experts you talk to saying about the likelihood of stocks finding their footing to post yet another year of gains?
The main thing that I'm hearing from people that I'm talking to on Wall Street is that there should still be optimism that 2022 can deliver gains and end the year higher than where it came in. The main question is the near term. We're hearing from a lot of portfolio managers saying they expect a choppy next 2, 3, 4 months. I was talking to a couple people who help take companies public, and they said they're really setting their sights on what April will bring. What will the economy look like in April here in the U.S. and globally as we potentially deal with future variants of COVID, as people continue to adjust to a potentially or another likely rate hike from an investment standpoint, and as we really get a better grip on what the U.S. economy and what the global economy is looking like, again, as we continue to hopefully step forward from what has been a brutal pandemic, all things being clear.
You know, one thing that we've seen since the bottom of the stock market is that every time you see some kind of dip, we see buyers come in, an army of buyers come in to bid prices higher. It's called buying the dip, right? And it's worked so well over the last couple of years. This year, however, we're looking at the stock market nursing losses for 2022. Why is buy the dip not working?
We're not seeing the same rush from both retail investors and Wall Street pros. There's a lot of uncertainty about, again, what will the next month, 2 months, 3 months look like? We are hearing from retail traders that they are putting money into broad ETFs that track things like the S&P 500, things that track the NASDAQ 100, but we're not seeing the robust demand to buy a dip and snatch up a dip because, again, there still is so much uncertainty of what the Fed will do. How will the real economy be shaped by Fed rate hikes, by inflation? There's just a general uncertainty, and obviously the market doesn't like uncertainty. But Scarlett, one thing I personally am really keen to see is what will we see on Monday and Tuesday of next week, as it is the end of the month and the beginning of February when people tend to get paid. We normally see retail investors buy more dips when checks hit their bank accounts. So that'll be an interesting signal for me to see if some of those retail investors will be stepping back in like we have seen for really the last year.
Bailey, do you anticipate individual investors giving up on stocks and moving into other investments like commodities, NFTs, crypto?
It doesn't seem to be that way. I talk to a lot of individual investors who are on things like Twitter, StockTwit, Wall Street Bets. And if you are into the cryptocurrency space or if you're into something like NFTs, there is definitely a demand from people who are into that kind of an asset. But generally speaking, what I'm seeing and hearing more from individual investors are they're selling ideas of the Cathie Wood. They're selling these high-flying growth stocks that they have seen shoot up over the last few years and are really putting their money into kind of easy, calm investments like, again, ETFs that track the broader market, ETFs that have a little bit of balance, even if they're tech skewed, because it's easier to kind of put cash in, make sure your money's going into that and not worry too much about the ups and downs, especially if you're an individual investor with a longer term horizon who doesn't necessarily sweat the 10% correction in a month.
All right, Bailey. Well, thank you so much for joining us and giving us the much needed context on that meeting today. Really appreciate it. That was Bailey Lipshultz joining us for more on the Fed's meeting today.